Hi, this is James Shugg with Westpac London's end of day report for Wednesday, August the 18th. Well, it doesn't last long, does it? I mean, we had a very positive day on equity markets yesterday, but it's turned pear-shaped again today with significant losses across Europe and the US market currently trading down as well. Earnings results are part of the story. Intel and IBM and others are disappointed. So whereas we did have a run of analyst expectations being beaten by various firms, the more recent story has been one of either sales, profits, or missing analyst expectations, or some other feature of the report disappointing markets. There was no actual US economic data of note today, but in Europe we saw a return to current account deficit in February. There was a string of current account deficits for several years that sort of ended in about July last year. We've had a couple of monthly deficits since then, but mostly surpluses. February saw a return to deficit. There was a 7% plunge in European construction output in February. I think that's the biggest fall ever in the history of that series, and the national data showed France down 0.4%, Italy down 10%, and the Germans down 17%. The annual pace of decline is now 12.9%, which is pretty close to what it reached at the depths of the 2008-2009 recession. It's a noisy, volatile series. We don't pay too much attention to it, but it's stark in terms of the weakness that it implies. What really upset markets, or the two things I think, firstly, the Bank of Spain reported that non-performing loans of the Spanish banks are now running at just under 8.2% of total lending. That compares to less than 1% of lending being bad 5 years ago, 2007. So a day after a Spanish T-bill auction went pretty well and markets were enthusiastic about that, one day later we've got markets worried about the bad loans that Spanish banks are holding. Tomorrow, of course, we've got a Spanish bond auction. Most of those bonds will probably be bought by the Spanish banks. A few months ago that might have been a good thing because it shows that the banks have got the funding from the courtesy of the ECB to help pull down yields and to help finance the government. But when you think about it, the very close interrelationship between the fragile banking system in Spain and the over-indebted government in Spain in an economy that's receding like Spain is. Remember, Spain was the only economy in Europe that didn't get a forecast upgrade from the IMF yesterday. There are still plenty of risks related to Spain anyway. So the other thing to mention, the unemployment numbers were not quite as bad as expected in the UK, and employment has now risen for 2 quarters. There's a bit of a disconnect between economic growth and jobs in the UK. So when markets were in turmoil back in the last summer, but the economy was still growing at about a 0.6% pace in the third quarter of 2011. Roughly the same time period, roughly the same quarter, actually it's June to August, we actually saw a 178,000 plunge in jobs in the UK. Since then, in the fourth quarter, the economy contracted 0.3%, but we saw jobs growth of 18,000, and now in the more recent quarter, 53,000 jobs were found in the December to February quarter. So it's usually it's the case that the economy shrinks and then jobs sort of follow. The economy grows and then jobs sort of come through with a lag, but seems to be working the other way around in the UK. We also saw the Bank of England minutes to the April meeting. What was interesting was that Adam Posen, who's been a long-term dove on the committee, who was voting for easier monetary policy well before many of the others, he dropped his vote in favour of an immediate further extension of the Bank of England's asset purchase program. So whereas in April it was a 7-2 vote for leaving things as they are, it was 8-1 this time. And in fact, David Miles, the sole supporter now of further immediate quantitative easing from the Bank of England, he said the case was now finally balanced. So it seems that the recent inflation scare with the commodity prices pushing higher, it seems that some or more of those committee members are a bit concerned that inflation may not be falling as quickly as they had anticipated back in the February projections they published, which coincided with the most recent extension of the asset purchase program. I mean, our view is they probably still will extend the asset purchase program, but maybe May is looking perhaps just a little bit less likely for the actual timing of that announcement. In other data today, not much to report really. Just the Bank of Canada, they put out their monetary policy report, a bit more detail behind their upgrade to their Canadian growth forecast that was published yesterday in their statement when they left interest rates on hold, but announced a slight tightening bias. So really that's about it to report on the activity, on the data and sort of news front. In terms of markets, we've got a 0.4% loss on the London market. The French market's down 1.6%, the Germans are off 1%, the Spaniards plunging 4%, and the Italians off 2.4% today. Dow's off 0.5% at the moment. Remember, no data, just disappointing earnings results to report there. Commodity markets, we're looking at 1.6% loss for crude oil today, reversing yesterday's gain. It's back at $102.48 a barrel. Gold prices are off 0.5% today at $1,642 an ounce, and we've got a 0.4% copper price loss to report to you. The Aussie dollar, I haven't got it in front of me. What's the Aussie at the moment? Well, I'm pretty sure it's 1.0365. So we're looking at about a 0.5% loss compared to when we were speaking yesterday. And that's basically been driven by the deterioration in risk appetite today, the mostly negative commodity price story, the losses on equity markets, and I imagine also the minutes of the Reserve Bank's meeting earlier this month, which were published earlier this week, which have hammered home the point that there's most likely going to be an interest rate cut in May. That news has been compounded by media reports in Australia suggesting that the rate cut could be even bigger than a quarter of a point. Possibly not as big as 50 basis points, but maybe something novel, something new, something like a 35 basis point cut. Well, we'll know in early May. Okay, that's it from me now. You guys should watch out for our friends at the NAB putting out their the latest business survey, and in New Zealand, it's the CPI for the first quarter. Okay, I'll speak to you with more tomorrow.